We are in the middle of it right now. The 2020 stock market crash. In my humble opinion, the crash is not over, people. And today I want to share with you the 5 lessons that I have learned so far. I've picked up a bunch of lessons in this crash so far. I think these are really interesting lessons. The first 2, quite frankly, are going to surprise a lot of you. It's going to surprise a lot of my long-term subscribers who have been following me for years now. So I'm really excited about those lessons. I can't wait to share those. That is the first segment of today's video. And one thing I want to mention off the bat, I've been investing for over 20 years and I'm still learning lessons each time there is market volatility or a major change in the economy. And I hope at home all of you have been learning as much as I have. I know on my Twitter, I recently ran a question, hey, what are some of the lessons that you have learned? And it seems like so many people from the community, you're all sharing your lessons as well. And the list is long. So it's a great time to be learning. Great time, in my humble opinion, at least the strategy I'm taking is enjoying these lower stock prices to accumulate world-class companies at progressively better purchase prices. Obviously, though, my heart goes out, heart and prayers to those affected by this awful coronavirus. That's segment 1 of today's video. Segment 2, I'm going to cover 2 recent stock purchases. I purchased shares of StarBucks and I purchased shares of 3M Company. So I'm going to discuss both of those. Really exciting. And then segment 3 of today's video, we had a meetup, very successful meetup yesterday in Dixon, California. 4 subscribers, 4 community members showed up. So in addition to myself, that was 5 of us in Dixon. That surprised me because Dixon, it's more of a kind of suburban town. It's not a major city. And so it was so wonderful just to see the reach of this amazing dividend investing community here on YouTube, PPCE and dividend investing for everyone. I love you all. I'm going to recap the meetup today. It was a very successful meetup. So very long agenda today. Now the first segment, the volume level may be a little bit lower. I was filming in my car yesterday on the way home from the meetup, so you may just need to adjust the volume a little bit here and there, but I know you're going to enjoy it because those lessons are really exciting. So let's get started with another dividend investing video. What is up, everyone? I am in the car. It's been a while since I've done a car vlog. All the true OG Thug Life investors who have been around a while know what it's all about. Ride or die, ride with me like Nelly. And I want to share some insights today in the first segment of this video, just talking about what I have learned so far from the 2020 stock market crash. There are 5 lessons I've learned so far. One of my favorite things about a crash scenario is the volatility compresses time. Time gets compressed, and what happens when time gets compressed is the lessons, the learning gets compressed as well. This is an opportunity for myself, for all of you at home, to accelerate, improve, as investors, to become better investors because of the compression of time. And so I used to work at a company where one of my bosses said, you never want to waste a good crisis. A crisis is always an opportunity to learn. Now, obviously, I'm very happy with how my portfolio is performing in the downturn. I don't lose any sleep. I'm a dividend investor, been there, done that. I actually look at this as an opportunity to add shares of stock in world-class companies at lower prices and to accelerate my cash flow even quicker. And so I love a good downturn like this. But also, I have experienced in these kind of volatile scenarios, it just accelerates my learning. For whatever reason, it accelerates that. And I hope that's what's happening with all of you as home as well. And so what I would suggest is, as you listen to what I am speaking about today, do your own exercise at home after this video. Do your own exercise and write down, hey, what did I learn? What did I learn so far from the crash? Because I really think that this is an opportunity to elevate as investors. It's just so exciting from that perspective. Now, obviously, my heart goes out to everyone affected by the coronavirus, and prayers go to anyone affected with health issues. And I'm not trying to make light or speak inappropriately about that scenario, because I truly do care. I am truly thinking and praying about those folks. I am just commenting in this video about the financial markets. And so one of the first lesson, well, before I get to that, by the way, just shout out to my friends Chris, Mike, Dylan, and Rami. 4 of you showed up to the meetup here in Dixon. I'm in the parking lot right outside of Starbucks now. I just left the meetup, and before I drive home, I thought I'd just get a head start on this video. I'm going to talk more about the meetup in the second segment, later segment of today's video. I'll summarize the PPCE and meetup today from Dixon, California, as I drive back from Sacramento to the Bay Area. But anyways, the first lesson I've learned so far from this stock market crash, and mind you, I don't think the crash is over. I think there will be more lessons, and I think time will get compressed even more because there will be more volatility. But anyways, the first lesson I learned so far comes down to this concept, and I'm doing this in my car for a reason, of ride or die. How many of you at home have heard of that term, ride or die? Typically, the way I've heard that term before, that phrase before, is it pertains to relationships. It's basically who you marry, or your spouse, your significant other. Have you found your ride or die? And it basically means that if you find that person, it's the one you're willing to kind of ride with till the very end. No matter what happens, you're sticking it out, you're with them. And I personally, from this crash, kind of had an epiphany. Ian, you have 44 stocks. You love them all. They will all stay in your portfolio. You will not sell. But you already have this concept of small, medium, large. But it's kind of, in 2020, you're focusing a lot on these higher yielders. And a lot of these higher yielders, quite frankly, they're not the core stocks. They're not the best quality stocks of your 44. And I start thinking, when the stock market is tanking, I'm trying to feel the love for which ones are my ride or die stocks. It's not necessarily the ones I've been super focused on lately. The stocks like Wells Fargo, for example, it includes an important position in my portfolio, gives me exposure to financials. We actually just spoke about this in the meetup. Having stocks like that, it's valuable. It's valuable to have that diversification in the financial services sector. But quite frankly, when things get bad, and I'm just thinking, like, what do I really love out of my stock portfolio? It's not Wells Fargo. It's not these ancillary positions. It's my ride or die stocks. It's the Starbucks of the world. It's the Johnson & Johnsons of the world. PepsiCo. It's those types of stocks. It's 3M, for example. I love you, 3M. I've been adding more shares. I'm going to talk about this in today's video as well. And I've been buying more Starbucks as well. I used my funds, or our funds, my wife and I, from Frugal February. We saved $1,000, deployed that into Starbucks stock. I'm going to talk about that in the video today as well. But it's this concept of ride or die. For whatever reason, during this crash, I had this epiphany. That, Ian, you ought to focus a bit more on your ride or die stocks. And so for me, what I'm going to do going forward is I really want to focus on quality. I want to focus on what I'm passionate about. I want to focus on just what makes me feel good as an investor to hold. And maybe I'll leave a little bit of current yield on the table. Maybe I won't potentially have as much cash flow this year than I otherwise would have had. But what I start thinking is there's this element of risk, but there's also just this element of happiness. What is going to make me most happy in life right now and in the next crash, and also in good times? It is focusing, and it is focusing on premium quality ride or die stocks. And so I'm going to share, actually, when I get home, I'll put this together. I'll interject a segment of video that shows what are my ride or die stocks, because I want to share it on the screen with you all as well. I'll do it at the end of this segment so that you can see it when I get home. But going forth in this year, I'm adaptable to change. I don't have to stick out the strategy that I set forth of just focusing on the high yielders. And for me, at least, I'm at that point where I want to focus on quality. And it's interesting because I'm in a unique situation where I do these YouTube videos. And quite frankly, because I do a lot of YouTube videos, sometimes I'm compelled to buy more and more stocks because it fuels my content. It's something I've been cognizant of. I never lie to myself. I speak the truth, and I've been transparent with this with you as well. I've mentioned this to all of you on YouTube before, so I have to be conscious of that. I also have to be conscious that as a dividend investor, I've enjoyed buying more and more stocks in different segments, and I've done this intentionally because it helps me consciously deploy money. Because when I buy new stocks, it forces me to come up with money to buy them. And so there are benefits of adding these other stocks. Oftentimes I've used this as a mental trick. Ian, add Wells Fargo, because it gives you a reason to deploy more money and trick your mind into generating more money to put in the stock market. But just going forward after this crash, I want to maybe move away from that strategy a little bit. I want to focus more on my core. I want to find my ride or die stocks like I have been and just focus on those. And I have to get comfortable as well with ancillary positions. I have some ancillary positions like Wells Fargo. Positions are kind of smaller. I haven't built them to size. It's kind of messy just having these one-off small positions. I'm not going to sell them, but I have to get comfortable holding these smaller positions and just focusing on ride or die stocks. That's what makes me feel good, gives me the happiness and the joy. And after all, the point of long-term dividend growth investing, or the best thing you can do in long-term dividend growth investing, is to do something that is encouraging. It's compelling. It keeps you focused on the strategy. And for me, one of the best ways to do that is to buy the stocks that I'm passionate about. And so that is one of the first lessons. Maybe it should have been more obvious. I know some of you out there have been telling me for a while, Ian, you have too many stocks. You're too scattered around too many stocks. And maybe you guys saw it before I did, but I needed to make that evolution as an investor. And one of the sub takeaways from all of this is at home, all of you on your own journeys, use this crash as a way to evolve, as a way to challenge what you've been doing, as a way to break certain assumptions, just as I have been. And you know what? Some of those ancillary positions like PPL, I probably will pick up more shares here and there. Wells Fargo, for sure, I will do that. But I've been neglecting some of those core stocks. And also, maybe because the stock crash is starting to affect some of those core stocks, maybe I finally feel good about buying them. So certainly that's part of it. Maybe I didn't feel good about buying my ride or die stocks at extreme valuations, but now that they're coming back, maybe to more reasonable valuations, it gives me more of a compelling case to go that ride or die route. But certainly for the foreseeable future, I want to focus on the ride or die stocks. I want to build a core. I want to buy what makes me happy. I want to buy premium quality. And when I talk about premium quality, I'm talking about stocks with a good brand name. I'm talking about stocks with low debt. I'm talking about stocks with amazing fundamentals and margins. I'm talking about stocks that have a wide variety of products and product diversification, stability. I'm talking about stocks that have a competitive moat. I'm talking about stocks that have a long track record of increasing the dividend. I'm talking about stocks that have a reasonable payout ratio. I'm talking about stocks that honestly tend to trade at premium valuations just because they are of quality. People ask me, Ian, why is Coca-Cola a quality stock and Royal Dutch Shell is not? I own them both. The reason is Coca-Cola has a competitive moat. They have distribution. They have a wide amount of products. They have high margins. They have a product that is not going anywhere. And Royal Dutch Shell, by contrast, sells oil. Oil is a commodity. Oil is not priced with them. They have no pricing power. Royal Dutch Shell has a bunch of debt. Royal Dutch Shell is facing changes in oil consumption. Now, I personally believe that peak oil is not coming for a while and that oil is here to stay. I've talked about that in a recent video. I love oil companies as well. I own a bunch of them. But there's no comparison, in my opinion. Coca-Cola is a premium stock. Royal Dutch Shell is not. This is subjective. Maybe some of you at home have the complete opposite opinion. But the fact of the matter is, and the point here is, I have to do what works for me, and what works for you may be completely different. The lessons that you learn from the crash may be completely different than what I learn. And so just thinking here late at night in the car on the way home from the PPC Ian meetup, and just wanted to share that first nugget of wisdom that this is one of the things I learned from the crash so far, and this is the best part of the crash. I love these lessons, and it doesn't mean I've been doing anything wrong. It just means I can evolve as an investor, and I can do stuff that will better align with my happiness and my long-term success. But as I mentioned before, not selling anything, not changing, not selling or trimming any of my 44 positions. I love them all. But certainly going to be focused more on my core. And finally, there's some value there in those core stocks as well. All right, everyone. So quick stop here in Fairfield. I'm getting closer to home. slowly but surely. And I want to share another lesson that I've learned from the recent stock market crash. This one is going to surprise you all. Before that, I want to share some artwork on the screen right now from my man Donnie. Donnie is a subscriber. He's a friend of mine. Shout out. He's a real good friend of mine. Thank you, Donnie, for what you've done here. He created this artwork to share with me for his respect of this channel, of this community. And this really I don't know what to say. This is a work of art. It is beautiful. It is something that really made my day. It just this is what makes it all worth it to me, is the community. It's the friendships. It's the people. I love you guys. Donnie, you are my man. Thank you, my friend, for this amazing gift, And I plan on printing this out and putting it right up in my office. This is one of the coolest things I've ever seen. The reason I am showing my man Donnie's artwork here is it embodies this whole thug life lifestyle. Thug life investor. I'm known as the thug life investor. And thug life investor, it kind of encompasses a few things. I think it encompasses going against the grain. For example, when Warren Buffett sells, I buy. Hope you're watching, Warren. And for example, I'm a dividend investor. I plan to hack the system, if you will. I will live off of dividends. I'm already using dividends to pay some of my bills. And so I'm hacking the system. In that respect, I am a thug. I'm a thug life investor. And over the years, I've been very transparent with the community that I invest also in sin stocks. Literally, I've written the book on sin stocks, a white paper. I'll link to it in the description below if you want to check it out. And I own the sin stocks in my portfolio, such as Altria, BTI, and Philip Morris International. I own those ones. And I'll tell you, this is something, it's going to shock you. I'm not selling. Definitely not selling. But I've come to the realization, and this is something that started this year. It kind of started in 2020. It started, honestly, we have kids. We have 2 kids. We started going to church consistently this year. Again, after a few years, the old church we were in kind of closed. We had kids. We didn't really find a church to kind of go in person for a while, but now we're attending church in person regularly every weekend, and I've been getting more spiritual. I've shared this in some of my prior videos, and so that's playing into it as well. But also, again, in the last segment on Ride or Die, for whatever reason, a market crash, it gets you thinking. It gets you evolving as a person, as an investor. And I'm open to that. I like evolving. Obviously, my roots will never change. I'll always be a dividend investor. I'm always going to be buy and hold forever. I'm always going to be I don't sell kind of investor. That's just who I am. But within my platform, within my strategy, I'm open to evolving and tweaking certain things. And so one of the tweaks, now that they're on sale especially, but even if they weren't, as just mentioned, I'm focused more on quality, on ride or die stocks. But another tweak I'm going to be making right now, and you're going to be surprised, is no more sin stocks. Seriously, I'm not going to buy more tranches of sin stocks. And part of that is because I'm a parent. Part of that is because of my spirituality. Part of it, quite frankly, is because my allocation is pretty big to sin stocks. And so, yeah, I could come across here that I'm doing it for all these holy and special reasons, but honestly, part of it is because I have a pretty big allocation there. But what I really decided is these sin stocks, one of them is in my top 15, Altria. I don't even know if I'm going to keep it in my top 15. Certainly, I'm not going to sell at all. But what I've decided, quite frankly, is for a number of reasons, mainly how I'm feeling in my heart, quite frankly, is at this time I'm going to hold what I have, but I actually am going to stop reinvesting dividends as well. This won't be right away. That'll probably be a little bit later this year, but I'm going to stop reinvesting dividends. I'm going to take the dividends and use them to buy other stocks. And I'll tell you now, I'm remembering one of the reasons I had this epiphany during the downturn. Quite frankly, I am very proud of 3M right now. I am so proud of them because during this coronavirus, what they're doing is they're ramping up production of their masks. And they have employees working their hearts out around the clock, 24/7, to produce more masks. And these masks are doing good, especially for our medical professionals. They're protecting them so that they can work their jobs at hospitals, saving lives. God bless all of you medical professionals out there watching this channel. I love you guys. Real round of applause from me, and I imagine from most people watching, for what you do. You take risks with your own health, your own life, to help other people, and that is amazing. And what I love about investing in 3M, God bless them as well, is they're producing the masks to protect you and to allow you to do your job. And that is an example of so many wins. I'm winning because I'm buying a premium company. Comparison of like 3M, for example, versus, I'm picking on you, I'm sorry, Royal Dutch Shell, but I love you, I own you as well. But the comparison between 3M and Shell, come on, 3M clearly a more premium company, at least for me. It's got more product diversification, it's got pricing power, it's got patents, it's got the science side and innovation. Although, look, Shell's got that as well. They're doing some cool, innovative stuff. But they got the brand recognition, competitive moat, financial stability. They're not relying on a commodity. All kinds of good things at 3M. And anyways, I start thinking, as an investor right now, I win buying 3M because I'm buying a world-class premium company at a discount, in my opinion, or at least at fair value. I'm getting a dividend. Maybe it's not as big as Shell's, but I would say it's a safer, more premium play. So I believe in my heart that by buying 3M, I'm winning as an investor. But also, I'm placing my capital behind a company that's just doing good out there. They're doing good. My capital, it can do good. It will do good. It's doing good with 3M. And I think that's just really cool. And it's kind of something when times get bad in society and you start seeing people out there suffering. You're seeing people suffering because of a virus. And I just want to root for the people that are doing something to change that. They're doing something to improve that. Now, don't get me wrong. I believe there is some value to the product that Altria creates. I honestly think for a responsible adult consumer during hard times, there's some value just for folks going out and taking a break and enjoying one of those products, taking some of the stress off, taking some of the stress out of the day. I think if this crash gets worse and the economy actually slows down because of coronavirus, and it might, you're seeing signs of that with some of the production reports out of China. Hey, during a bad economy, job market's more difficult. It's harder for people financially. Look, companies even like Altria provide a service to society if used responsibly for adult consumers. And so, look, I'm not here to make a moral judgment. I'm certainly not going to put anyone down that owns it, just like me, because I own it. I ain't selling it. But I've come to a point in my life where it's like I just said, it's fine-tuning. It's fine-tuning the strategy. And one of the fine-tunes, this is something that's been brewing in my mind for a while now, is even though I'm the Thug Life investor, and I hope you guys still think I'm Thug Life, because I still think I'm Thug Life, but I'm still hacking the system with my strategy. I'm still thinking contrarian. I'm still buying, man, when Buffett, you're selling. I've got all that going. I still own all the Thug Life stocks, but I'm kind of at that point, parent, man of Christ, just thinking about what's going on in society with coronavirus and what different companies are doing, and how I can place my capital behind companies like 3M that are doing so much good. J&J as well. AbbVie, for example, doing good out there. Man, I just that's just how I'm going. And so again, it's not necessarily something I wouldn't have arrived at otherwise. And I know some of the community have been kind of wondering, Ian, why do you love all these sin stocks so much? It's interesting. That's where my start was. I bought them. I was almost 100% sin stocks in the early days. It served me well. I'm going to pay respect, pay homage to my past. I'm going to continue to own those stocks and bear the harvest of their dividends. But going forward, it's these fine tweaks, it's these evolutions of the investor. And ultimately, one of the most important things of a dividend investor is dividend investing is long-term investing. Dividend investing, it's buy and hold forever. Dividend investing, to reap the benefits of the harvest, to enjoy the cash flow, it takes a long time. It's not swing trading, it's not day trading. And to stick with the game, I hammered this point home in so many different videos, to stick with the game, you have to find all the fundamentals, all of the basics. Obviously, all of that has to work out. But above and beyond that, you have to do stuff mentally that excites you, that makes you feel good, that makes you feel good about the strategy. And that's why these first two epiphanies that I've had from the crash, they're really along those lines. I will feel better as an investor if I focus on my core, on my ride or die stocks. I will feel better as an investor if I stop buying more tranches of sin stocks. It might be opposite. You might feel better as an investor if you buy more tranches of sin stocks. That's how I used to be. And at that point in time, it served me well. In my early days, it motivated me. It really got me into things focusing exclusively on sin stocks. So for that stage in my journey, it was right. But for me now, to stay in the game, to stay compelled to keep going, to be excited, to be more excited than ever, I'm making these tweaks. And you might even be able to sense this through the video. For me, and I don't want to make light of a horrible situation, but these crashes in the market, it almost has renewed my focus in a way where I'm more excited about the market now than I've been for a while. Because I feel like I'm really living life now. I'm living life because of the volatility. Because of the volatility, life is moving faster, and I'm thinking more, and I'm evolving more. And I just hope to impart that spirit, because I know a lot of people at home, they're feeling down. A lot of people are feeling, oh, I've lost some money on paper. Hey, I don't comment on other people's situations. You have to do what's right for you. You have to follow your own journey. I'm just sharing my personal journey here. Very important to state that I don't give advice. I'm not a financial advisor, just sharing my own journey here on YouTube. But for me, at least in my own journey, a lot of people are unhappy right now. A lot of people are feeling the pain. I am just feeling excitement because I'm feeling like I'm really living, and there's just something about the atmosphere right now with what's going on in the market that's given me this renewed focus. I'm making these changes, small changes, but they're taking me to the next level as a dividend investor. So anyways, that's big takeaway number 2, big lesson number 2. I'm going to head on out now to my next stop, and I'll close out the top 5 lessons. I'll probably do the next 3 in the next segment. That segment won't be quite as long, but please share in the comments below. I hope I'm still the thug life investor that I have been. I know in my heart that I am, but at the same time, all thugs, we got to evolve, and so that's what it's all about. All right, I'll see you at the next stop. All right, everyone. So I want to share my final 3 lessons out of the 5 that I've learned from the 2020 stock market crash so far. I am tired. I'm almost home now. I'm in Foster City. Shout out. We actually had a meetup here in Foster City not so long ago. And sign up for my local Bay Area crew. By the way, I will be announcing our next meetup soon. It will be in San Francisco, not too long from now. I know some of my OG friends have been waiting for San Francisco again, so we'll have that meetup soon. And so the final 3 lessons that I learned from this stock market crash are actually quicker than the first 2. One is just flat out that dividend investing works. I have not lost any sleep over the crash. We were talking about this in the meetup today. I wouldn't be surprised if we're still in the middle of it. The stock market crashes quite a bit more. I wouldn't say that Dow 20,000 is out of the mix. That could be possible. And I'm not losing any sleep. It doesn't faze me at all. And so that's one of the exciting things about dividend growth investing. During this stock market crash, for example, Home Depot announced a major dividend increase. This is a stock that I own that I love. Also, Cedar Fair, stock has been plummeting, but they announced record earnings, and they forecasted that they think 2020 will be strong because of the amount of season passes already sold. There's been a lot of good news coming from dividend companies in the form of dividend increases, but I think a lot of that good news, it's just getting completely pushed aside during all of this market volatility and drama. But as dividend investors, and this is something that was apparent in the meetup today in Dixon, a lot of the subscribers at the meetup were resonating with this message. It seemed that not really anyone there was losing a lot of sleep. It seemed that on average, attendees were feeling pretty good about the dividend strategy. And I can't really speak for others, but that was the vibe in the meeting. And personally, I feel really good right now. I honestly feel a little bit more alive than before. I guess maybe I'm just a kind of enjoy seeking that adrenaline, that action that comes with volatile times. But I feel alive. I feel really excited that my passive income keeps growing. And so that is... I can say all I want that, hey, dividend investing, it's always great, it always works, it's a strategy for me, but actually living through a crash, being in the midst of it right now, and feeling this sense of peace and calm, that's a whole nother thing. That's very exciting to see it panning out in real time. And certainly out of my 44 stocks, I feel pretty confident here that I don't think I'm going to witness any dividend cuts. Quite the contrary, I expect to witness many dividend increases ahead. By the way, it is so refreshing driving home and seeing all of the brands that I invest in. Shout out Shell. I give you a hard time, but I saw a Shell station on the way home. I saw Chevron, McDonald's. We held our meetup at Starbucks, and I don't know how many Starbucks I saw on the way home. As I was driving down the 880, I saw Clorox, their headquarters downtown Oakland. I saw their big sign, shout out Clorox. Dimension, McDonald's already. Saw you, McDonald's. I see all the brands that I own, and again, just fills me with a sense of joy, peace, calmness, owning these amazing companies. And many of the ones just mentioned on my ride or die list, some of them not, but look, it takes a pristine company to make it in my portfolio at all. And so it was exciting to see all those brand names on the way home. So that was lesson 3. And it sounds kind of like a simple lesson, but it actually is amazing to see it pan out in real time. And like I said, stock market crashes more from here. I feel pretty good sleeping at night. I have no worries. I love this strategy. Dividend investing is a great strategy for these kind of times. And I look forward to averaging in more, to buying more stock at progressively lower prices. Although I will not dip into my emergency fund. I will not get ahead of myself. Okay, so 2 more. One of these is interesting. There is a popular app that is being used by many newer investors, younger investors, that has crashed over the last 2 days. I hear a lot about this online. And so one of the lessons, I already actually published a video on this many years ago, and it's been something I've consistently discussed through the years, that for me, I always prefer the big, stable brokerages, the big guys, the ones that have been in business for decades. And so one of the lessons, it's not really a lesson for me because I don't use this app, but I see it emerging from the community, is be careful where you place your hard-earned money, because if it's with a broker that's going to crash during volatile times, look, it puts investors at a disadvantage. Look, I'm a buy and hold forever, so I don't sell. But look, other investors have a different approach. This is a community of many different types of investors. We all like dividends, but some of us are shorter term, some of us are longer term. There may have been investors in our community trying to make different transactions that couldn't have done so because of these glitches. And so for me, this just kind of reinforces the message that I have been sharing throughout the years, that for me at least, I have a strong preference towards the big stable brokerages. And sometimes the message online from various experts, it's very genuine, but other times it may be biased by affiliate marketing, because I know a lot of these apps provide affiliate programs, and those may skew the message one way or another in the conversation online, because a lot of people are affiliates of these various disruptive apps and brokers. And so just keep that in mind as you're researching apps and brokers online. But these days, in my opinion, the big guys, they're offering no commission trading, and so I just don't really see the value of going anywhere but the best. That being said, I have to give credit where credit is due, and look, these apps have brought a lot of younger investors to the market who may have never invested otherwise, and maybe these investors, they're going to graduate now from some of these apps that got them started to more sophisticated brokerages that are now offering these free trades. And so I think they play a role. They have played a role. They'll continue to play a role. They're great. I love it. They brought people to the market. But just a lesson It's wild to me that something would crash like that and that investors could not make reliable trades. That's honestly unacceptable in my personal opinion, but I hope it works out for the best for this app that I'm talking about, and also for members of the community who use it. I wish them all the best, because at the end of the day, I'm an advocate of investors, and I'm excited that this app has brought and continues to bring newer investors to the stock market. And so that's just one of those lessons. But the side note is, look, as investors get a little more sophisticated, boy, it's probably good to ask just that question: is this app still the right thing, or is a more sophisticated broker better? And one of the things that came up during the meetup today is that some investors in the community like to diversify, have funds in various different types of brokers for this very reason, to just hedge the bets. Just like diversifying stocks, why not diversify brokers? And this is something I've held near and dear to my heart over the years as well, that for me, that's something that really resonates. Have money not just in one broker, but spread around a little bit. It's just another way to diversify some of that risk away. And so anyways, that was one of the other lessons that I learned, that I think honestly a lot of investors out there are picking up from the recent stock market correction in 2020. And so I was just checking my notes. You guys know, oh geez, who has been around since the days when I was doing the notes? Those were the early days when I was filming the videos outside with the notes. Shout out. If you've been here since then, please put it in the comments below. I truly love you. You are a true OG Thug Life investor. And so, speaking of the Thug Life, I'm still Thug Life investor. Look, I am, I love rap music. I listen to rap music all day and night. And I quote it here quite a bit. And you know, it's funny, one of the community members on Twitter was mentioning and reminded me of a song by Juvenile called Bounce Back. Check that one out when you got some time. We're going to bounce back. All of this stuff, this drama will resolve itself at some point, and the stock market will bounce back. But until then, I'm going to enjoy the journey, enjoy the volatility, and live in the moment, and enjoy the moment, enjoy kind of living life during crazy times as I do. But the last one, jotting down or looking at these notes that I jotted down earlier, is on the coronavirus. I literally read a report that I couldn't believe this. I thought that society was more elevated than this, but it just surprised me that sales of Corona beer are way down. Way down. And consumers were polled that would you buy Corona beer, and some were saying like absolutely never again, because of the coronavirus. Keep in mind that the coronavirus is nothing to do with Corona beer. They're not related, but because Corona beer has Corona in the name, it has a stigma against it now. And the reason I'm bringing this up is this is something I learned during this correction, is that honestly, in my humble opinion, the markets are just not efficient. Stock market is not efficient. It can't be efficient because of examples like this, that the average consumer out there is scared of Corona beer now because of the coronavirus. If that's what society is thinking, it just goes to show how much opportunity is out there to find opportunities in the stock market when stocks are mispriced. And there's so many people out there that believe you can only invest in the index fund because the market's efficient, this and that, efficient market theory. I don't believe in efficient markets. I believe that the markets are somewhat efficient, but they're also, especially during times like this, inefficient. And when an investor is seasoned, like myself and like many of those in the community, I was blown away, by the way, with the meetup today. Many sophisticated investors out there who have been investing, some of them a really long time, like my man Mike, shout out. Very smart group, very sophisticated group. And sophisticated investors out there are able to find opportunities in inefficient markets. And I just think the simple statistic that society is getting so confused over the coronavirus and the Corona beer is just one data point that I picked up from this stock market correction, that the stock market, it's just another data point showing me that it's not efficient. This is not an efficient market, in my humble opinion. Anyways, those are the 5 lessons that I've learned so far from the crash. I'm going to keep an open mind. I hope I pick up more. As time gets compressed because of volatile times, because of crazy times, I enjoy living in the moment and picking up insights. Share in the comments section below what you've learned from the crash so far. If you've picked up anything, share it with the community. It's the best part of the community. It's a collaborative community. And so that was one segment of today's video, and I look forward now to switching gears. Next time you see me here, I'll be back in my studio, back in my garage. It'll probably be tomorrow. I got to get some sleep. I'm really tired. You guys can probably tell my eyes are kind of glazing over. Real tired. Need to get home, get my sleep. But I'll see you in the next segment. I want to do a recap of the meetup today. And I also want to share some stats on the stocks that I've recently purchased. So a lot of good stuff, everyone. Thanks for hanging in there. Love you all. See you in the next segment. All right, everyone. So it's the second segment now of today's video. I'm back here in my garage, and I want to talk about 2 stock purchases I recently made. The first one is Starbucks. You may recall my wife and I participated in Frugal February. We were successful in saving $1,000, and we decided to deploy that $1,000 of extra savings into Starbucks. And so I'm going to share some statistics on the screen right now. And I'm excited to share Starbucks because you see, I bought it at $80.81. It's already down a little bit, but hey, we're in the middle of this crash. There's a record amount of volatility, and quarterly dividend 41 cents, annualized 164. So the starting yield, it's not very high. It's a 2.03%, but the dividend growth rate, we'll see in a minute, is quite exceptional. The 2020 EPS estimate is $3, puts the forward PE at 27, and the market cap is $92 billion and change, with debt of $20 billion and change. And so you get a sense that they are managing their balance sheet, they are managing their debt well. And my favorite statistic with Starbucks is the dividend growth, 20.7% 5-year compound annual average growth rate for the dividend. Now, this goes back to the last video that I shared here on YouTube, which I will link to in the description below. One of the things I've seen with this crash is the more marginal stocks, the ones that aren't quite as premium, they've fallen, and it's easy to go out there and find, say, an 8% dividend yield. But with the premium companies, my favorite companies like Starbucks, yeah, they've corrected a little bit here, but they're still trading awfully expensive. I mean, look at Starbucks. The PE ratio that I paid on my purchase price was nearly a 27. And so the premium companies, again, they're not really on sale yet. Yeah, there's a few of them like 3M and Johnson & Johnson that are showing some sale-like valuations, but most of my ride or die stocks right now, they're not in bargain basement territory. That being said, there is something to be said about having quality in one's portfolio. I'm excited about adding more quality to my portfolio. I'm going to focus probably on J&J and 3M because those are 2 that have a lot more value here. But I am also equally excited to buy shares in companies like Starbucks that are of high quality, that have high growth rates, that looking 20 or 30 years out, I'm going to be very happy with my purchase price. But as this crash continues, it will be interesting to see how it affects the more premium stocks. And I wouldn't be surprised to see some more premium names like Starbucks at some point go on sale. And that would be a blessing. That would be something welcomed, as I want to add more and more to my premium stocks at lower valuations, because so far they're not on sale. And I think a trap that I mentioned in my last video that I believe some investors may be falling for is it's kind of the more marginal, the more risky, the more junky stocks, if you will, that are really going on sale. But when I look at my portfolio as a whole, most of it's in premium. I have some of the more risky stuff, but I diversify. But again, it's the junk right now that is mostly on sale, in my humble opinion. All right, I want to talk about 3M now as well. I've been averaging in, and I feel really excited to add to 3M because not only is it a premium stock, but it's a stock that's part of this solution here for the coronavirus. They're working their hearts out on these masks. I love them, and I'm going to share some stats on the screen. So I purchased more shares of 3M at $150 and change. It's already up a little bit, but before it was up, it was down. It actually plummeted yesterday, and now it's back up, and a lot of volatility with this stock market. I still think we're right in the thick of it, right in the middle of it, and I wouldn't be surprised if the major indices drop quite a bit more. We'll see, but as a dividend investor, that is a good thing. On 3M company, my starting yield is a 3.9%. The forward PE is 15.87 on my purchase price. That is a very attractive PE for 3M. And check this out, market cap 87 billion, debt 21 billion, and growth rate on the dividend 7.5% on average per year last 5 years. The reason I'm pointing out debt here is as I look at towards my more premium positions where 3M and Starbucks, they're both more premium, and quite frankly, they're on the ride or die list. These are the ones that I love. These stocks manage their debt very well, and I think that's an important thing. Yeah, we're in a low interest rate environment, but I think a lot of companies are making the mistake that we're in a low interest rate environment, so let's take on a lot of debt. Let's do acquisitions. Let's take on a lot of debt. Let's buy back shares. I like companies like 3M and Starbucks that are managing their debt. They're being prudent with their debt, and that is one of the criteria for making my ride or die stock list, actually. That's why I love these companies so much. So anyways, I made those two purchases, excited about it, and I will continue to average in to high-quality premium companies in the coming weeks and months. It's an exciting time to be adding to my dividend stocks. They're surely not really on sale yet. Maybe 3M is fairly valued, if not on sale a little bit. Starbucks is not on sale, and so I look forward to hopefully sale-like prices in the future months. We shall see. All right, long video today, so I want to quickly go into segment 3. I'm going to talk and recap the meetup that we had yesterday in Dixon, California, and this was a lot of fun. A lot of fun. Shout out to Rami, to Dylan, to Chris, and to Mike, my homies who came and attended the meetup in Dixon, came from all over to make this happen, and it was a good time talking about dividend stocks. And so I want to recap some of the things. Obviously, this is a global channel, and I know a lot of you wish you could make the meetup. Don't worry, I will be doing more of them, and hopefully more of them outside of California in the future. But for now, hopefully the recaps help convey some of the good stuff that happened during the meetup. So check it out. I'll share it on the screen right now. And some of the things that we started off with was just lessons about the crash. I knew I was kind of going to do a video about, hey, what have I learned from the crash? And so I check out my Twitter. I'm not going to recap it here, but on my Twitter, there's some really good insights from community members on what they learned from the crash. And then right in the meetup, the attendees shared some of their lessons that they've learned so far. And one of the ones I just see resonating, Twitter and also at the meetup, is this notion of don't deploy capital too quickly, because the stock market crash has begun, but we don't know how long it will last. And we know that a lot of the more marginal stocks are really on sale, but what about the premium stocks? They're not really even on sale yet. And so wouldn't it be a shame to deploy all of one's capital right away, and not only do it right away where the market hasn't fallen as much as it will, but potentially putting it and allocating it towards stocks that might not be the premium names? At least I don't know if everyone's looking at it that way, but that's how I'm looking at it right now. And I do see it as a recurring theme that a lot of investors, they're like, hey, hit the brakes. Hey, let's spread it out. Let's save money to deploy in the future. And that is so hard during a market crash because everyone wants to just jump in, myself included, and deploy money. But having that patience, and even on a day where the stock market goes up, knowing that, hey, there's probably a lot more down days ahead. We just need to wait for those. That's one of the takeaways from the community. Another one is, I love this. It's so, I share my trades, most of them on Twitter. I love doing this because it shows just how imperfect I am. When I purchased stocks, sometimes I hit the bottom, sometimes I time the bottom, but most of the time, quite frankly, I don't. Like with Starbucks, I'm already down a little bit. It's probably going to go down a lot more. No investor can time the bottom perfectly. Some people say they do, but they're not sharing everything. They're not sharing all of the information. And so one of the lessons from a lot of community members was just this thought, and this kind of, there's some investor anxiety, and I face this sometimes, that, oh my God, if I buy here, What if it goes down more? I'm not timing the bottom. But the way to overcome that is by subscribing to a dollar cost averaging, a time diversification strategy. You guys have seen this play out in real time, the way that I have been deploying money into 3M. So that's a topic we spoke about a lot. And I think it's just nice to sit down with like-minded people where we all kind of face that same fear of buying too early or not timing the bottom, because I think it's impossible to time the bottom, but psychologically you see stuff online and you're like, wait, but that person got the bottom, but you know what, maybe they did that time, but the other 10 times they didn't. And so that is, I think, just very helpful for folks to sit down and talk about that as a team, as a community. And so something else was, the correction may be more than the virus. I've talked about this a bit. Coronavirus, is it really causing the full extent of this correction? Or are we just kind of, this bull market kind of played out, this bull economy played out? Is it time for a bear economy, a bear market? There might be more to it than the coronavirus. And the last thing that I thought was really interesting that someone brought up was just the notion of job security and being mindful, hey, markets going down. Is that foreshadowing some kind of economic activity around the corner? Is the economy going to face some weakness? If it does, could certain jobs at certain places be, a little bit more at risk than they were in the thriving economy? And what does that mean for us as investors? Should we be stockpiling a bigger emergency fund? Should we be working some extra hours at work to prove to management that, hey, we really we're one of the best performers on the team? There are a lot of ramifications of that, but I think it's a helpful reminder to the community that, hey, job is really important, especially before you've reached financial freedom. The job is what fuels living expenses and creates capital to invest in dividends. And so, yeah, being mindful of one's job, especially during times like this, hey, that's in my opinion, a very prudent practice to do. And so that's how we started off at the meetup. Then we talked a bit about diversification. We talked about the value of dollar cost averaging and time diversification. We talked about the value of just diversifying across different industries. Like I was mentioning, hey, I own Wells Fargo. I like it. I think it's a good company. Hey, anything has to be a good company to make my list of 44 stocks. But the fact of the matter is I'm not as excited about Wells as I am about Starbucks. That being said, one of the points that was brought up at the meetup was, hey, Ian, you don't know it all. I don't know it all. No one knows it all. And there's beauty in diversification that, yeah, it might be nice to have only 10 stocks in my portfolio. But at a certain point, given the size of my portfolio, given just the unknowns out there, having that diversification, it's going to come in handy. There's going to be a day that comes where the financial sector is doing really well. Another sector, the coffee sector, is not. And it's going to pay off having that exposure to financials because it's going to lower the volatility of my overall portfolio in the future. And so we talked about that a bit. I think that was an interesting theme because it gets me thinking where I'm making these minor adjustments in my strategy. But the key takeaway here, I never make really radical changes. And the reason for that is every stock in the portfolio, it plays a role. And yeah, I'm kind of turning my back here and some of the junkier stocks for a little bit of time. But you know what? 6 months from now, 9 months from now, maybe I'll change my strategy again. And that's why I like to fine tune, but I don't like to make radical changes because all of those 44 stocks, they are there for a reason. And that diversification industry group is key. We talked about broker diversification a bit, and I'll tell you what was interesting with that is I'm not going to name names, but one of the popular stockbrokers that investors use in our community, it's been having a lot of technical challenges. And I did a tweet about this. Personally, I like going to the big brokers, the big popular brokers who have been around for decades because they're robust, they're stable. Why wouldn't you? They're free now, free trades. Why go with anything else? But needless to say, a lot of people still like these apps and whatnot. And I commend the apps because they brought a whole new era. They brought a whole new age group, if you will, of investors to the table, because a lot of these investors, they were not attracted into investing by the old school platforms. It was the newer age platforms that got them to be investors. But what we started talking about a bit is just broker diversification. Does it make sense to have all of one's assets in one broker? Or how about spread it out a little bit? Spreading it out and diversifying that way could be good because we're seeing right now in real time a broker crashing. And if that's where one has all of their eggs in that basket, and you can't even use the brokerage, it's not working, hey, that's problematic. Stuff happens. And so a lot of takeaways from that. But for me, I always tend to favor the large brand name brokers that have been around forever, because you've not seen those types of technical glitches with those big brand name brokers. And so good points on that from the meetup as well. One other thing is just like, there's some neat stuff we talked about. I thought one that was really neat is there's this company Altria that I own, and a lot of you do. Talked about this earlier, and they got FDA approval to try this product IQOS in the US market. IQOS, their counterpart, Philip Morris International, very popular in Japan. It's a heated product. It's a new innovation. And this investor was saying he wanted to do some market research and understand the reception for this product in the US. And so what he did is he went to YouTube and he literally found YouTube channels that are from people that use these types of products, and they review them. And he said some of the reviews in the US, they were actually a little bit lackluster. And so the point there is that's a real world data point. Another real world data point. Go to Costco and you see that all the toilet paper is gone. Who makes all the toilet paper? Companies like Procter & Gamble, Kimberly-Clark, some of my favorites, my ride or die stocks. And so the takeaway is sometimes as an investor, it's not only about the financial analysis, but it's also about the real world analysis. And I thought that was a unique perspective that investor brought to our meetup. Also, in terms of neat stuff, I thought this was really neat because I've seen people make this mistake recently in the stock market. And it's hard for me to call it a mistake because I only share my personal journey here. I can't, and I don't comment on other people's situations. So I kind of look at things from a distance and I see people doing stuff and I kind of think, oh, it might be a mistake, but I don't know their situation. So it's hard to comment. But needless to say, one of the mistakes that I believe investors make in a crashing stock market is buying at the top, seeing it crash, liquidating because they can't take it. And then never to come back. Or when they do come back, it's so far in the future that none of the benefits of stock market invested are harvested for that investor. And so one of the things that was discussed at the meetup was just this concept of testing the waters gradually. And so I thought this was neat. Like hypothetically, let's say a brand new investor has $10,000. Why not just play it really conservatively and put in 500, put in 1,000? That's it. Keep the other 9,500 or 9,000 just liquid cash. Come back in a year. For me, I think that is, if someone is nervous and they're just getting into the market, that is so much better. Yeah, you potentially forego dividends. Yeah, you potentially forego some upside in case you might have called the bottom perfectly. But as we know, that's not very likely. But it's a lot better to do something like that, in my humble opinion, just speaking hypothetically to my own situation at least, than to buy like a bunch of stocks, like put in the whole 10,000, lose money, and then be out for the rest of time. And so some investors are talking about extreme dollar cost averaging here and really pushing it out, stretching their time out. In this kind of volatile time, that might be an interesting strategy for newer investors to contemplate. I thought it was just a neat concept brought up at the meetup for people at least to think about who are new to the stock market. And I can totally see, quite frankly, if I was new to the stock market now, maybe I would average in a little bit slower. The benefit I have is I've been in the game so long and my cost basis is so low. And I have all these built-in gains. And so it's just I have a very unique situation. And it's just got me thinking, well, if I were starting over again and it was this weird, maybe I would exercise some extreme dollar cost averaging like was discussed in the meetup. So one last tidbit from the meetup, and one of my favorite things about the meetup is there's always a stock pick. There's always a stock pick that comes to the table. And the cool stock pick that came to the table at our Dixon meetup was this company called Rollins, ticker symbol ROL. This is a company behind a lot of the big like pest control brands. I'm forgetting their names. I think Clark's might be one of them. Another one like Orkin. I don't know if I'm getting their brands perfectly, but basically the big brand name pest control, it's owned by Rollins. And so this is a really cool company. They pay a dividend. The PE ratio is sky high. I haven't even looked at the fundamentals, but just off the bat, you tell me pest control, I'm like, man, you got me at that. That is such a cool business because and the fact that they have kind of a monopoly, that they've done this roll-up strategy, they've bought all everything that is pest control out there. At least that was the way that it was discussed in the meetup. Surely there's probably some independent pest control, but the idea is Rollins is the big guy in the space. What is so cool about that is just think about it. Good economy, bad economy. If you have a rat in your house and your kids can't sleep, your wife can't sleep, you can't sleep, you're scared, you're going to call pest control. I don't care how much money you have or don't have. It's one of those life necessities where you got pests, man, you're taking care of those pests. And so this is one of those companies that more so than a lot of others, it's, in my humble opinion, like I said, the subscriber, the friend who brought this to the meetup, hey, man, you got me at pest control. That is so exciting. Now, I really don't want to add more stocks to my portfolio. I've got 44. I've got more than enough. That said, Rollins is on my watch list. This is a very high PE stock, so I'd like to learn a little bit more. Why is the PE so high? It may just be that it's such a premium business, that it is such a monopoly, that is such a coveted space being in pest control, because people, you need pest control, you need the pest control, you're paying. That might be why, but I'd love to learn more about Rollins, and share in the comments below if you know about Rollins, you own it. This was one of those really cool stock picks. Every time at every meetup, there's always one. And we will have more meetups in the future. Next one will be in San Francisco. I look forward to it very, very much. So those of you in California on my local crew email list, stay tuned. And I'll link to that in the description below. If you're not on the list, you want to be apprised of California meetups, I will put that in the description below for all of you at home. Hey, thank you for sticking in the long video. I hope you enjoyed it if you made it this long. By the way, I've got some new merch. That's what I'm wearing today. And so if you want to support PPCE and you want to look really cool, you want to look fashionable, I'm wearing a size large here. Premium merch, custom merch, PPCE, and I love this design, by the way. It's one of my favorites. Check out my store. I'll link to it in the pinned comment below. Your purchase means the world to me. And I hope it's something that's also very satisfying for you, because you get to wear every day your passion for investing for dividend stocks. And so really, really cool stuff. And so here I want to close out with the disclosure. And in terms of I'm going to do the disclosure second. In terms of disclaimer, today's video is not investment advice. I'm not a licensed investment advisor. Today's video, it's just for your fun and entertainment. If you're going to go out and invest in the stock market or anywhere else, please consult a licensed financial advisor first. Literally just sharing my personal journey here on YouTube for fun and entertainment. And as always noted, additional disclosures, disclaimers in the description below. Investing in the stock market carries high risk. It's very volatile right now, very risky times. And so keep all of that in mind. And in terms of full disclosure, I am long StarBucks, ticker symbol SBUX, 3M, ticker symbol MMM, Wells Fargo, ticker symbol WFC, Johnson & Johnson, ticker symbol JNJ, PepsiCo, ticker symbol PEP, McDonald's, ticker symbol MCD, Clorox, ticker symbol CLX, Duke Energy, ticker symbol DUK, Procter & Gamble, ticker symbol PG, Coca-Cola, ticker symbol KO, Kimberly-Clark, ticker symbol KMB, Home Depot, ticker symbol HD, PPL Corporation, ticker symbol PPL, Royal Dutch Shell, ticker symbol RDSA, Altria, ticker symbol MO, Philip Morris, ticker symbol PM, BTI, ticker symbol BTI, AbbVie, ticker symbol ABBV, Cedar Fair, ticker symbol FUN, and Chevron, ticker symbol CVX. I am long all of those stocks. I own all of those stocks in my personal dividend stock portfolio. All right, everyone. Thank you so much for hanging in there. I will see you in the next dividend investing video.